Every empire convinces itself it has minted a brand new kind of money. Eventually, each discovers it hasn't. Money runs on hard constraints, stubborn, impersonal laws that ignore politics, pledges, and optimism. They're not carved into constitutions or drilled in school. They're learned the hard way, forgotten, then rediscovered in panics. If you don't know them, the game always feels stacked against you. Today, we'll dig up those buried laws from alloyed coins in Rome to today's digital levers, and why the table was never even. Begin with the bluntest rule, Gresham's Law. In the 1500s, Sir Thomas Gresham told Elizabeth I that bad money drives out good. When two currencies circulate, one sound, one watered down, people spend the weak and squirrel away the strong. Rome proved it. As the silver denarius was cut with base metals, citizens weren't naive. They settled taxes and debts with the flimsy issues and hid the older, purer pieces. Medieval monarchs replayed the trick with clipped edges and copper swaps. The lesson: when rulers tamper with money, people rout around them, pushing the weak coin into markets and sequestering the real. Trust frays from the edges inward. Now the mirror image, Thiers' Law, Adolphe Thiers. In true breakdowns, the logic flips. Good money chases out bad. Think Weimar Germany in the 1920s, prices sprinting by the week, banknotes by the wheelbarrow. No one held marks longer than a heartbeat. People bolted into dollars, gold, cigarettes, or straight barter anything solid. Zimbabwe and Venezuela echoed the pattern. Gresham charts the slow rot. Thiers captures the sudden stop. Between erosion and implosion sits the Cantillon effect, which explains why inflation feels crooked. In the early 1700s, Richard Cantillon observed that new money doesn't reach everyone at once. Those nearest the spigot governments, banks, insiders, spend first. By the time it filters to workers and savers, sticker prices have already climbed. Early recipients buy assets at yesterday's tags. Late recipients pay tomorrow's. That's why money creation can fatten Wall Street while Main Street treads water, why QE after 2008 floated stocks while wages lagged, and why stimulus evaporated into rent and groceries. Inflation isn't merely a number, it's a transfer. Incentives channel gains upward while the bill is disguised as cost of living. Then the clamp that keeps you from climbing out, financial repression. After World War II, states buried in debt needed a quiet fix. Tax more and invite revolt, default and torch credibility. They chose a third door, constrain options for savers and let time do the work. Central banks held rates beneath inflation, guaranteeing negative real returns. Capital controls fenced money in. Over time, purchasing power eroded while public debts shrank in real terms. The playbook reappeared after 2008, near zero rates for years, and again in 2020 to 21. Asset owners rode the wave, cash holders drifted backward. Most people only felt poorer without spotting the mechanism. Some laws scale to empires. Enter Triffin's dilemma, the reserve currency trap. In the 1960s, Robert Triffin warned Congress, if the dollar anchors world trade, the U.S. must supply dollars, i.e., run deficits so everyone else has liquidity. Short-term, commerce hums. Long-term, foundations weaken. The more dollars exported, the shakier the gold link until 1971, when Nixon shut the gold window and fiat reigned. Since then, chronic trade gaps, offshored industry, swelling debt. Yet dollar primacy kept the carousel spinning. The paradox bites. To stay the world's money, America undercuts parts of its own industrial base. Meanwhile, challengers circle. China, Russia, and BRICS probe alternatives. Central banks stack gold at multi-decade highs. The crown is also a curse. Next, Goodhart's law. When a metric becomes a target, it stops telling the truth. Policymakers love tidy figures. 2% inflation, 5% unemployment, 3% growth. But steering by the gauge bends the road. To deliver 2% inflation, authorities crushed rates and flooded liquidity-levitating assets, while essentials housing, healthcare, education raced ahead of official baskets. Spreadsheets showed stability. Daily life shouted volatility. with GDP fixating on growth-spurred debt binges, offshoring, and bubbles to keep the dial moving. Manage the numbers long enough and you stop measuring reality. Finally, the arithmetic of our age, diminishing returns to debt. Early borrowing kickstarts output. $1 of debt buys $1 of GDP. As leverage swells, the punch fades. $1 buys $0.50, then $0.25, then noise. Debt climbs, growth stalls. The engine no longer accelerates its strains. U.S. public debt, well above $30 trillion, now props markets and entitlements more than it builds new productivity. Every empire finds this ledge. Rome adulterated coin as expansion waned. Bourbon France borrowed into 1789. Britain creaked under post-war burdens. America feels the same gravity now. Borrowing buys time, not escape. But the map still has a few brutal landmarks that complete the picture. Here's one the textbooks bury in footnotes. The impossible trinity, the Mundell-Fleming trilemma. You can choose two, never all three. A fixed exchange rate, free capital flows, and independent domestic monetary policy. Bretton Woods kept exchange rates steady by curbing full capital mobility. Many emerging markets tried fixed pegs with open capital accounts and discovered they had effectively no policy freedom. Whenever a state claims it can defend the currency, welcome infinite capital and steer the economy at home. Remember the triangle. One corner always breaks. Next, the nasty feedback loop that follows excess leverage, debt deflation, Irving Fisher. When balance sheets are stretched and asset prices wobble, households and firms sell to raise cash. Forced sales push prices lower, which raises the real burden of debt, forcing more sales, bankruptcies, banking stress, and further deflation. It's not a cycle, it's a spiral. In these moments, stimulus can look potent on paper while quiet balance sheet repair cancels it out in the real world. Then the quiet ceiling on printing. Seigniorage, limits. Think of it as the inflation Laffer curve. Early monetization can fund the state. Beyond a threshold, velocity jumps, the tax base shrinks, and real revenues fall even as prices rip. That's why chronic money finance tends to end not in steady inflation, but in regime change. New units, new rules, sometimes new governments. Layer on Tinbergen's rule. One policy instrument can reliably hit only one target. Central banks try to manage inflation, unemployment, financial stability, exchange rates, and asset prices with a single main lever: short-term rates. Push on one metric and you'll deform another. The more goals you stack, the messier Goodhart's law becomes, because the target itself stops describing reality. Finally, a structural truth modern debates skip. Money is both a network and a narrative. Units endure when they clear transactions, store value across time, and anchor trust across borders. That triad doesn't live in spreadsheets alone. It lives in credible institutions, enforceable law, and productive capacity. You don't defend a currency with slogans. You defend it with trustworthy rules, surpluses somewhere in the system, and the willingness to take pain early instead of late. Put these pieces together and the pattern sharpens. The trilemma sets the outer geometry. Debt deflation explains the crash path. Seigniorage limits cap the printing press. Tinbergen's rule exposes why one lever, many goals, fails. And the network narrative lens reminds us that money lasts only as long as people believe and can actually use it without friction. So, step back. Money isn't magic. It bows to laws as cold as physics. Weak currency crowds out strong until crisis flips the flow. New issuance tends to lift insiders first. States can repress real returns to dissolve debts quietly. Reserve currencies hollow themselves out over time. Targets warp truth. And debt, taken too far, devours tomorrow. These aren't curiosities. They're survival codes. They explain why savers get shaved, wages lag, mortgages bite while markets levitate, and why nations rise on trust, yet sag under leverage. Here's the hardest line. The game wasn't built for you to win. Ordinary people live in transparency, elites in opacity. You file returns, they move claims. You clutch melting cash, they hold climbing assets. The system obeys its own laws, and unless you learn them, you'll play blind. History doesn't repeat, but money rhymes. Learn the pattern or be ground by it. If this sharpened the picture, subscribe. History keeps the map. I'll show you where to look.